in this video, I'm going to take a look at risk versus reward. The biggest thing about risk versus reward that you have to keep in mind is that you are not going to win all of your trades. It's just a fact of trading. There are going to be losses. And the idea is that risk to reward, you want to figure out the best possibility to make yourself successful. So, for example, if you're risking one to possibly make five, then you're going to do a lot better than somebody who's risking one to possibly make one. Because when you are risking the same amount that you're standing to gain, you need to be right more than 50% of the time. But if you're risking one to gain five, for example, in order to break even, rough math, of course, you only need to be right one out of five times. So that's one way that you can have trading kind of work in your favor. So for example, I'm going to take a couple of setups on this chart and I'm going to look at the risk to reward and kind of give you an idea of the things that you should be thinking about. So on this chart, we have a massive hammer followed by a short hammer. This is a daily chart of pound yen. Now, classically speaking, you would have a stop loss if you took a break of the top of the hammer, this hammer here. You would have a stop loss down here below the bottom of the hammer. And the idea being that, you've broken through support. If you went long here, based upon this candlestick, you would need an entry of about 150.50, once you clear that area, and you would be risking down to 145 roughly. So you're looking at about 550 pips that you're risking that you could lose. And you got to ask yourself, how far can this go? Well, in this case, you can make a real argument for the 155 level as a possibility. But the problem that you run into is you're working against the trend. So you kind of have to take that into account. Plus, there is noise before you get there. Matter of fact, I see quite a bit here at 153. So in this scenario, you're risking like 550 pips to pick up 250. That's a horrible risk to reward ratio. You'd have to be right like almost every time you traded in order to make money on that particular kind of setup. So that in and of itself should have you thinking that you don't want anything to do with this trade. Now, on the other hand, we had a very bearish candle here. We initially tried to rally and then we fell apart. I'll use the same kind of thinking that right here at the 164 level is pretty significant resistance, and we found it again. You would go short at the bottom of this candle, which is basically 160. So we're looking at about 400 pips here. But where could you go at that point in time? Well, the first target, I think, would be the lows again that you just recently hit. So that's 154. So now you're looking at 600 pips and you're risking 400. So that's a little bit better. That's basically 2 to 1. And at that point in time, you can afford to be a little bit quicker to take that trade. As I zoom out, you can make an argument for this two-day reversal signal here in an obvious downtrend. So you have to think that the odds are with you. 175 is the stop loss, and 172 and a quarter or so is the entry point. So by using these two candles as a selling opportunity, where do you aim? Well, you aim for the most recent low as a reasonable one. And in this case, you're looking at roughly 275 pips risk, but you're looking to make all the way down to 164. So you've got 800 that you're trying to pick up. Now that is good risk to reward ratio, plus it's with the overall trend. So by using this kind of thought process, even if you lose this trade, you get four trades just like this. You only need to really make one to break even. If you get two, going with the trend, which isn't asking a whole lot, you've come out ahead. And these are the things that you have to think about before you start placing trades.